You're now tuning into Clearing Spotlight, where markets meet clarity and institutions navigate liquidity, risk, and infrastructure. Today, another reputable guest has graced our show to share his experience of the Fintech industry. It's my great honor to introduce you to Andrew Mackenzie, the CEO and founder of Agant. Coming from a strong background in traditional regulated finance, where he played a key role in building a major deliverable foreign exchange business, he's now taking that deep compliance-first mindset and applying it to the digital asset world as the founder of Agant, his aspiring UK-regulated, GBP-dominated stablecoin. Andrew, welcome to the show. How are you feeling today?
Yeah, great. Thanks for having me. Really good to be on.
Great. I believe that we should kind of set the mood for this conversation with you and I. I'm genuinely, excited to dive into, your mastery of the industry. So before we get into the kind of heavy topics, just a kind of very broad introductory question. You spent a long time in high-value corporate FX and payments. If you could use your digital sterling today to instantly solve a financial headache for your past self, what would that be?
It's a good one. I think for me, everything always seemed to happen at about 3 p.m. on a Friday afternoon. And trying to send a SWIFT payment, trying to facilitate a cross-border payment, then, the pressure's kind of on. So I think no cutoff times. I think for us that was always a bit of a bugbear, when you knew you were up against it. And the way that some of the firms that we worked with, their business banking functionalities worked, it still involved them physically getting in the car and driving to a branch to go and authorize a transaction. So when you're up against it and time's running out, those lethargies that still exist can add quite a lot of undue pressure. So yeah, for me, if we could abolish cutoff times and money can move freely at any given point during the day, then that would be fantastic.
Right. Interesting. And things like cutoff times and settlement cycles, they have a little, relationship with legislation. And then as a kind of separate topic, there's that broad idea of legislation specifically for stablecoins. So if we can kind of focus in on that from your, kind of introductory kind of idea, you've established a company focused on GBP denominated stablecoins. UK is currently the only major economy without a clear and comprehensive framework. There have been some updates and some, evolvement of the thinking. But what's the most immediate economic risk this poses, and in particularly the threat of digital dollarization?
Yeah, I think there's a huge risk of falling behind. So, sometimes not having first mover advantage or second mover or even third mover is a benefit. I sometimes feel it's not an advantage. So I think the UK is in a really strong position at the moment because they can see different regulatory climates, whether you lean closer to the European setup or you lean closer to the US setup, but also some of the other ones further afield, what Abu Dhabi have done in the ADGM and also in Singapore and Hong Kong, etc. So there's a real opportunity to really look with a global point of view and see what parts of each are working really well and what parts aren't. So when we speak to regulators, we say you have this huge opportunity in front of you that you can see what's working. You're not having to put your finger in the wind and guess. But sometimes they still struggle to see that level of context and don't necessarily see it as an opportunity. So I think the biggest risk is falling behind. Yes, people say that the city has struggled post Brexit to maintain, its stature within global capital markets. But we are seeing a resurgence in FX flows through London, in global bond issuance and debt, and London still very much is the leader in global money movement with the exclusion of capital capital markets in terms of raising capital and equities. The US is very much the leader there, but there's still a very strong position in the UK when it comes to moving money, and stablecoins and digital money allow organizations and businesses to move money more freely. And so capturing that opportunity is key, because I think as we've sort of seen within other aspects of crypto and digital assets, it very much has a habit of moving to the path of least resistance. And so when you can move things, when you can conduct business in a more transparent, freer fashion, be very easy for a number of these businesses to shut up shop in London and move to Abu Dhabi or move to Singapore and conduct their business there, because the same barriers don't currently exist. So I think it's a case of being fast. It's a case of being proactive and capitalizing on the business that is currently conducted and could be conducted in the city, bringing it into the 21st century, taking it on chain, and then developing and innovating from that platform.
You mentioned London being a kind of center for money movements, and so you've built regulated deliverable FX businesses in the past. How much do you think that there is a relevance of the experience of managing that high risk kind of business for navigating the kind of upcoming or proposed or consulted stablecoin regime?
I think what it highlighted, so I had a bit of an interesting career in that sense. So I used to work in agriculture, fell into crypto and digital assets during sort of late 2019, early 2020. Then after FTX went bankrupt, I ended up going back into traditional finance, into deliverable FX. So I'd spent some time in crypto, moving money with stable coins, working for a couple of different firms that involved a lot of rebalancing between centralized and decentralized exchanges. So I could see the benefits of using stable coins as a means of value transfer. So then when you suddenly take a step back and you go back into the traditional finance world and you start interacting with legacy systems, you realize the frustrations become even more apparent. Don't get me wrong, faster payments is great for anything under $1 million, Chaps does work, etc. But particularly in that cross-border piece, the lethargies become so apparent. I think the most surprising thing for me was the lack of transparency. So when you have a Swift transaction, that it can be in limbo and no one really quite knows where it is. Your sending bank knows it's gone, but the receiving bank can't see it, and everyone is just kind of in this limbo, sort of just having to wait and see. And so I think for me that frustration became very apparent, because generally a lot of the businesses that I worked with, most of them sort of were involved in the agricultural industry. It was generally a shipment of something that needed to move when it was on the lorry, and the payment wasn't going to be sent until the lorry driver had said, "Yep, I'm happy for this to go." And so, there was just this domino effect of that lorry needs to leave, wherever it was in France to get to the boat in Cali, and if it doesn't, then da 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 da. So I think for me, being able to do something when you want to do it in a reasonable time frame, it's huge from a productivity standpoint. So, I guess in some ways I'm inherently lazy. I like things to work as they should, and I like things to happen when they should. And so, all of the extra work that the traditional financial payment systems required me to undertake, I kind of didn't like, because I knew that there was a more efficient and effective way of achieving the same outcome.
And interestingly, in the last couple of years, you call it commodity financing or commodity related payments using crypto is one of the major use cases. So this is super interesting stuff. Anyway, back to the topics. There's this debate about whether the stablecoin pays yield or not. Should they be rebranded as digital certificates of deposit or treasury products reflecting underlying credit risk? And I know that you and the team at Agant had thought about having underlyings that sit beneath the stablecoin, perhaps not in the the common typical kind of set of underlyings. What's your thinking there? What's the rationale for that kind of set of conversations about yield, underlyings, and what the token is planned to be?
Yeah, so I think for us, it was taking a step back and really understanding what exactly were we creating and what did we want it to do. And I think a bearer instrument that is used for a means of payment, which, for us, that's like the most basic form of a stable coin, should do nothing. It should be as cash-like and as liquid as possible. And then you have everything else. Now, that doesn't mean to say that people can't use yield-bearing tokens, whether they're tokenized deposits, whether they're tokenized money market funds, or something else, can't be used as a means of payment and acceptance. I'm still very much in favor of that. But I think the sort of underlying foundation layer that we all use and we use as the initial cash leg should not yield and should not do anything, which is why we've expanded our product suite into different products to fulfill that consumer demand, and to different organizations want to take on different levels of risk and are quite comfortable with that. And it gives you a degree of flexibility, and if you can have certain alignment within the backing assets of your stable coins and and your yield products, which allows you to have that instant swap capability, which is particularly useful to a number of organizations. But for us, we spent quite a lot of time thinking about how we as an organization should look at yield, and should they underlying be naturally yield bearing or not. And we really came to the conclusion that if a stable coin is organically yield bearing, then it's technically not a stable coin. It technically becomes something else at that point. And therefore we decided not to take on that battle. One of the things for us that we're really keen on doing and are pursuing is helping large financial institutions move onto the blockchain and become the organization that works with them. So really for us, keeping it as simple as possible and trying to make all of the products that we were offering them look as close to the current products that they maybe use, within their corporate treasury function or within their collateral management systems, etc., was definitely the goal for us. And yeah, I think once you get that educational piece done, within the organization, and that's not just the teams that are the most innovative, it's their legal teams, it's their compliance teams, getting them comfortable and getting their risk team on board. You can then say, oh, well, we could start doing this. And they're like, aha, yeah, because that's just like X, Y, and Z that we already offer. And you're like, exactly. So I think for us, there's a lot of benefits to tokenizing yield products. But in terms of a pure stable coin, it should be as simple, as transparent, as liquid, and as secure as you can possibly make it.
Yeah, interesting. Thank you for that. And I do observe not many people understand the concept that a yield-bearing stablecoin is not stably priced, because the yield effectively makes the price of the token a function of the discounted cash flow of the product over time. But it's interesting that you have
exactly. Yeah. And I think you're seeing this debate with tokenized deposits as well. Right. And I don't think some people necessarily realize that when you hold, if you were to hold a tokenized deposit, you're basically taking the other side of the bank's balance sheet. You're directly holding bank risk, and that's why there is a return there. So I think there's almost this trifecta where you'll have stable coins, yield products that tokenized deposits maybe fall into, and I do actually believe we'll be in a world where we have central bank digital money. I don't believe it should be retail facing. I think for tier one banks to face that face off the central bank and deal with them as sort of their primary liquidity providers, etc., it probably makes sense for them to have a digital relationship with the central bank. But I think different products fulfill different roles within global finance.
Interesting. Yeah, super interesting. Thank you for that. Skipping on a bit more, regulatory clarity is a large part of the conversation, but there's also the question about trust. Doing things on chain. So let's shift our focus and talk about one of the bedrocks of any high quality stablecoin, which is collateral security and verifiable proof of reserves. As I understand, FCA emphasizes operational stability. If there's a technical problem like a hard fork and a blockchain split, how does Agant protect the token's value and ensure its reliability?
So I think that stability piece is really interesting. For us, we have a platform that always allows people to come and redeem one for one. So we work very hard with various OTC desks and market makers to ensure that once we're live and our product is in circulation, that we're also able to support those functions through them as well. But I think it all comes down to trust, and how do you get trust? Is through transparency. And so for us, we would love to get to the point where we can do real-time attestations. we're a long way off that, and generally that the most sort of the biggest constriction there isn't us as an organization, our technical capabilities, it's some of our partners and how they're able to account and I guess attest the assets that they hold on their balance sheets, and within their funds. I think for us as well, there's other steps you can take to ensure that you have bankruptcy remoteness and that you have that Chinese wall between the management organization and the trust that holds the collateral. But yeah, for us, that clarity within the transparency, ensuring that we don't take any level of undue risk, that the backing assets that we hold for our stablecoin are, the mandate and I guess the covenants that we impose on ourselves is adhered to the highest level, and that we always ensure that everyone is aware of what we hold, how we hold it, and how we need to how we can dispose of it if in times of stress.
And then there's that choice of having a trust structure and a formalized trust structure which you can kind of trace through, versus having crypto assets on chain or algorithms that algorithmically backed stable coins. How important do you think in the current environment is that legal promise and the safety of the trust relevant to the products that get deployed to market?
I think it's paramount. I think for us, particularly given the types of organizations that we work with, knowing how the assets that sit on their balance sheet, if they were to hold those digital assets directly themselves, how they account for them, can they view them as cash and cash equivalent? If they can, where is that collateral? How is it used? How is it interacted with? How is it minted? How is it redeemed? Answering all of those concerns and effectively trying to eliminate every single one. Like, don't get me wrong, I think algorithmic stablecoins have a place. I think they're a really interesting and diverse product. But as organizations look to sort of digitalize their traditional financial functions, it's maybe not the most appropriate tool for them. There's a level of risk that they carry with algorithmic stablecoins, and if you look at almost the core mandate of a corporate treasurer, for example, is basically to preserve and secure, and then to get a return on the assets is quite a few points further down on their mandate. So really for us, it's about selling the benefits of interacting with digital assets and settlement that you get with blockchains, as opposed to here's some really juicy yields that you can go and get stuck into. I mean, I think there's a time and a place for it. I think for us, developing out the non-dollar stablecoin ecosystem is sort of the first goal, and then we can get more expansive and more innovative as we sort of start to develop and mature in that sector. But in order to get that sort of initial flow, initial volume and market cap circulating, we need to create something that people are going to feel like isn't too different from what they already interact with today.
So in that comparison of the trust-backed versus the crypto-backed and the stablecoin backed, the algorithmic-backed stablecoin, let's take another kind of refraction of the same question and say, when you look at stablecoins that are backed by a legal trust, can you give us, for people that wouldn't know, the difference between that and a stablecoin that was issued by an unregulated crypto exchange, and why would you consider them not the same?
So there's a myriad of points that you can start with. I think the first one is the adherence to compliance and controls, processes and policies. If we issued a crypto-backed unregulated stablecoin and something went wrong, I mean, a lot of this is generally doesn't matter when the going's good. It's when the going is not good and the weather's turned against you and now everything's quite stormy. How will that organization, the counterparty that you've sent your collateral to, how do they interact? If you're unregulated, you effectively have no requirement for governance, no requirement for processes and policies, no requirements to to act in a certain way in periods of stress. The holders potentially have no real claim on the business or on the collateral. Whereas within a bankruptcy remote trust, the holders are direct beneficiaries of that trust. They always have a point of redemption. If the business was to become insolvent and to be wound up, their assets are protected. They will always be made whole. We can ensure that, we can guarantee it. So I think there's a various levels of comfort and various risk mitigations that are taken on. I guess another key point, by being a registered and compliant entity, you can eliminate a significant amount of risk, and you can help ensure that the funds that financial organizations and other organizations are interacting with are clean. They're not in breach of sanctions or in breach of any any grey lists or blacklists or being used for bad intentions, etc. So I think it's just a level of comfort that it gives token holders.
Great, thank you for that. It's useful for people that are interested in understanding the questions about legal certainty and asset protection. That's very useful. Moving on, in terms of from critical, security is obviously critical. Speed and availability are also some non-negotiable elements. And so, let's talk about 24/7 element of what we do, and how that fixes some of the friction points in the payment system. You mentioned a bit earlier in your answer to the intro question. Some people have said to me in conversation that FX already works 24/7, 365 days a year, and there's no need for a stablecoin crypto rails. Is that statement, it comes up quite often, is it really true? And then why do stablecoins have the potential to replace fiat rails for FX?
Yeah, this is a really good one, because it's something that we are starting to get stuck into to a great degree. Yes, FX is largely available at all hours of the day, but not every banking system is turned on at all hours of the day. And so I don't necessarily feel at the moment it's necessarily the trade that's going to move on chain, but it's going to be the delivery of the cash legs, it's the post-trade settlement, so to speak. If it's a Sunday night in London and the Asian markets have opened, the London desk is not able to send a transaction unless you're a large conglomerate that is tapped into payment systems that not everyone can get. If you're a smaller business or financial institution, you don't necessarily have that level of access. Stablecoins, they're always on. You can always place margin. You can always send funds. And so I think for us, it's that side that we're quite interested in, but it's also the length of the settlement as well. Once you get into the depth of the correspondent banking system, yes, things can move very quickly, but they can also get stuck. And when they get stuck, they can get stuck for quite a lot of time, and people don't know where things are, and it can all get quite stressful. With stable coins, you can remove a number of those counterparties, and you can simplify and speed up the transaction, by huge amounts. And so I think that's where people are particularly interested in the on-chain FX world, so to speak, and that's generally where we're seeing the largest amount of appetite. It's being a tool to parachute into a domestic settlement system, as opposed to and to eliminate the complexities and time constraints that come with cross-border, as opposed to everything needs to happen on chain all at once.
Yeah, it's super interesting. When do we stop using either bureau de change to change our physical dollars or whatever, and then when do we stop paying credit card companies or local vendors to do the FX conversion? And when does it happen on chain? Super interesting question. Thank you for that. Kind of looking at that question, and then kind of applying a similar rigor to the on-chain world. What's the importance of being multi-chain by default to start with, and why is it essential for attracting institutional users and any users who want to operate across various digital networks?
Different organizations, different blockchains, different users of blockchains all have different objectives. And so they all deliver slightly different things. And it is very nuanced, but when you start to look at the confines, which, some regulated institutions, some corporates, some even, even retail operate within, they all want to achieve different things. And so I think that's why we've seen so many different successful blockchains. And for us, we don't want to be an organization that dictates where the funds flow. We just want to be the provider of the funds and make it really, really easy for people to move from fiat banking systems to on-chain banking systems and back again. So being currency agnostic, being chain agnostic is almost a core ethos of what we're trying to do. I think as well, liquidity fragmentation, not just within different stablecoins and different types of stablecoins, but also across chains as well. It needs to all be extrapolated away, and we need to be able to move from dollars on Ethereum to GBP on Solana. That should be something that is relatively straightforward and is possible, because two organizations, like I said, might have two completely different objectives, and those chains might fulfill two completely different types of roles, given what their key, I guess, decision-making factors are based on. So yeah, being chain agnostic for us is paramount. Not dictating to anyone where our flows are. We really want to capture as many flows as possible, and so ensuring that has always sort of been inbuilt. Plus, also, I guess, sort of super high level, and probably should have started with this. We don't know what the next 2, 5, 10 years looks like, and so the blockchains that we're interacting with today might not be those that are the best in the future. And so it would be remiss of us to put all of our eggs in one basket and say, "Yep, this is 100% the future, and everyone is going to use that." We don't have that reputation, we don't have that clout, and nor would we ever command where people should do business.
Interesting, thank you. And then pulling those two threads together from fiat traditional to the on-chain world, and how important is it to have the ability to enable near instant conversion between traditional bank accounts and stablecoin wallets? And how does Agant ensure that those on-off ramps are seamless for institutions? How does it actually work in the real life?
Yeah, it's a point that we've spent a lot of time working on. I think a lot of businesses focus on the on-ramp, whereas we spent a lot of time focusing on the off-ramp. We felt as though what's going to be a larger incentive for more AUM to stay on chain. And it's generally that people know that at any given point when they need to move back into their bank account, back into fiat at any given time, that they can do so very easily. And so for us, really understanding the various complexities and who is involved in various transactions, depending on the organizations that you're interacting with, whether it's a bank, whether it's a payment service provider or an electronic money institution, or whether it's an asset manager, again, there's always slight nuances there. And so I think for us, really deep diving into exactly how money moves traditionally, and then looking at where we can add value. Because, for example, if you're a pension fund that serves 12 months notice to your asset manager that you would like to remove the mandate and take it somewhere else, that money probably doesn't necessarily need to move on stablecoins. So it's also understanding when money needs to move very quickly, how it needs to move very quickly, and how we can build around that. So I think for us, how it really works, it kind of depends on the payment systems and the counterparties that are involved. But that's where we can add a lot of value in extrapolating a lot of that complexity away. So as far as our customers are concerned, if they're on chain and they want funds in their bank account, they send funds to a specific wallet address, and the funds arrive in their bank account. It should be as simple as that from an on and off ramping point of view.
Thank you for your insights. It's a ever evolving and quite complex industry, not least of which the part of stablecoins, and it's useful to get your views and your expertise on the on the topic. Almost at the end, I'll ask you one last question, and it's in the form of a continue the statement. So the statement is, I will invest in stablecoins because.
I think for me, it's the underlying foundation of global finance as it moves on chain. It's being that cash leg. We can do whatever we want above it, but we need that foundation layer that we settle into, whether that's paying for goods or services, whether that's settling a trade, whether that's moving value from A to B. And so I think for us, that's where we felt we needed to start. We have ambitions to go and build on top of, but it's very difficult to build on top of if your foundation layer is not as robust as it needs to be. So for us, that's really why we started with stablecoins.
This has been an incredibly powerful talk with you. Thank you so much for sharing your expertise with us and our listeners and viewers. With that, on behalf of LTP, we thank you for attending, and thank everyone else for continuing to tune into these episodes where we're dedicated to bringing professional insights such as yours. And it's a great way to shine a light on all of the good work and all the stuff that we're building in this industry. So thank you very much.